Hello and welcome to another 52 weeks of financial success. We are up to week number 8 and we're going to talk about debt elimination. Last week we talked about the importance of having an emergency savings fund. The reason why we need emergency savings is because when life happens, when Murphy's Law happens, when at the worst time something could break down, that's when it will, we need money that we can use to pay for it instead of having to use debt. So that's why I told you, if you did not watch last week, get as quickly as you can $1,000 saved in a money market account, and ultimately we're going to have 6 months to 12 months of our expenses in our emergency savings. But right now, we just want to have $1,000 because everything else, any other money that comes in that is not going to our main expenses, that are not going into anything else that are part of our budget, we need to eliminate debt. So why are we focusing on debt? Well, because when we eliminate debt, it allows you to do 3 things. Number 1, it allows you to save. Because when I do not have debt payments, I can put more away in savings. Number 2, it allows you to invest more. Because now, instead of putting in $50 every pay period to 401k, I can put in $250 or maybe even $500. But then third, it gives you the peace of mind to know that if something were to happen to my job, something happened to my income, I'm not so dependent on a certain amount of money because I have debt eliminated. Yes, I can reduce my phone bill. Yes, I can reduce how much energy I use so I can get those bills down. But it's very hard to just say, hey, I'm going to eliminate debt, and you do not have a plan. So that's what we want to talk about. What is the best way to pay off debt? I believe in the process that Larry Burkett, who was the founder of Crown Ministries, he came up with what is called the snowball effect. And what the debt snowball is where you take all of your bills, you write them down on paper. From smallest to largest, you want to focus on paying off one bill at a time. So let's say you had 5 credit cards. One was for $100, another was for $300, another was for $500, another was for $700, and another was for $1,000. And let's say the minimum payment on all 5 of those cards were $25 a piece. Well, the way that the debt snowball works is you want to maintain the minimum on every card except the one with the lowest balance. So the other 4, you're going to pay that $25 and no more. Okay? That's what a lot of us do. We'll send in extra. But with the debt snowball, we want to focus on one and put as much money as we possibly can on that one debt. So if I have put my $1,000 away for saving, that money that I did have going to saving, I'm going to put that with that $25 minimum payment on that one $100 bill. So if I've got now, let's say $50 that I'm paying towards that $100 card, in 2 months, I'm going to have that one card paid off. So then next, I move to the second card. Remember, we had $100, $300, $500, $700, and $1,000 credit card. We just paid off that first $100 card in 2 months. You are now going to take that $50 you were paying on card 1 and add it to the minimum payment you were paying on card 2. So now you have $75 going towards your $300 credit card. So in 2 months, we paid off 1. Now with the $75, as we apply it to this $300 debt, in a little over 4.5 months, you're now going to have that card paid off. So in 5 months, we were paying off 2 cards, where the process you were using before, you weren't making a dent in even 1 card. So if we move on down, 4 months later, we've paid off the second card. So now we take that $75, add it to the $25 of card number 3, which is now $500, okay? Because see, you're still maintaining the minimum payments on the other card. So your balance is not decreasing by much, but your credit is not being affected. So now we're taking our 75 plus the 25, now we have $100 going towards the $500. So in 5 more months, you will have the $500 card paid off. So you have paid off a total of $800 in credit cards in a little over 10 months. So almost in a year, you've eliminated 3 debts. Then you're now going to take that $100, add it to the $25 of the $700 credit card, and in 6 months, you will now have that $700 credit card paid off. So here we are going into 18 months, almost 2 years, where we've eliminated almost all of our debt. Then when you pay off that fourth card, you will take that now $125 plus the $25 that you were paying minimum on the $1,000 card, and you pay that $150 together, and now we're looking at 7 to 8 months, you will be debt-free. That is how the debt snowball works. And so my goal and action tip for you today, for this week, is to do this. Write down all of your debts, from smallest to largest. And I want you to think of an amount that you can commit to, that you will be dedicated to paying over and above what you're paying right now in all of your bills. So if it's $10, if it's $25, or maybe you can really get rid of some things and find an extra $100. Whatever that payment is, I want you to be committed to it, and I want you to start working on your debt snowball so you can start becoming debt-free, because the sooner we can become debt-free, we can get the maximum we need in our savings, then we can really start planning for our future, whether it's through real estate, whether it's through stocks and bonds, through our 401k, whatever. Now, if I went too fast, all you have to do is go back over this commercial again, go back over, listen to it, and pause it and start it, pause it and stop it. But I really believe if you follow the debt snowball, you are going to see the success that you need. Well, again, thank you for tuning in. I want to encourage you, if you have not been to our website, download our free chapter from our new book, 7 Secrets to Financial Success. All you have to do is go to charleswinfrey.com, put in your name, email address, and you'll be able to download our chapter. Well, we'll see you next week.